Good afternoon, everyone. Welcome back to our weekly market review. Today is the Chinese New Year edition. As usual, I have my co-host with me today with Ang Pao for all of you, Mr. Gerald Wong. Welcome to the show.
Hi everyone, Happy Chinese New Year. Wishing everyone prosperity in the year of the dragon.
Yes, a happy and prosperous new year ahead for this dragon year. So, Gerald, how has your Chinese New Year weekend been?
Well, it's been very busy with all the visiting, catching up with family and friends, but also having to update this presentation to see what we have coming up in the markets in the year ahead.
Yes, definitely some developments in the market in the past week. This week we are having holiday on the China side, it's their Golden Week, and of course on Hong Kong and Taiwan as well, but not for us on the Singapore market. Today the STI is almost flat, and DBS seems to be running out of steam after the earnings results last week. So Gerald, can you take us through some of the developments last week?
Okay, sure. So quite a number of things that happened in the market, even though it was a relatively short week. Before we go into the sharing, just to highlight that today's presentation is for information purposes only and should not be taken to be financial advice. Okay, if you've got more questions, we have a upcoming SIAS that is on the 21st of Feb. That is next week. And we will be taking your questions that you might have on the stock market. Okay, if you find the session helpful, do leave us a review on Google. And to be able to participate in SIAS, you can consider joining SIAS as a member, either by scanning this QR code or going to this website. And the membership for SIAS will cost $12 per year or just $1 per month. Okay, so if you've got some spare Ang Pao money, do consider joining SIAS as a member and be able to educate yourself as a more informed investor. Okay, so what we saw last week, quite a number of good news. Okay, the first one is that the S&P 500 hit the 5,000 level. So that's a very key psychological level that it managed to break last week after the gains of another 1.4%. Okay, most of this was driven by gains in the large cap tech stocks, where we saw that the Nasdaq was up by 2.3% and fueling the rally in the S&P 500. Okay, closer to home, the STI languished. Okay, we saw a loss of about 1.3%. And definitely what we are seeing in the US market has not translated to gains in the Singapore market. Okay, so what is driving this rally in US stocks? First and foremost, it is important to note that the US government bond yields is no longer falling. Okay, this fall that we see in the US government bond yields between November and December last year was driving a big part of the gains in the S&P 500. But what we have seen this year is that if I look at the US 10-year government bond yield, it is back above 4% once again, now close to 4.2%, versus say 3.9% towards December last year. Okay, so we are starting to see the US government bond yields going up once again as investors moderate their expectations of a Fed rate cut in March, as well as the pace of rate cuts for the whole of 2024. Okay, so what is driving the rally? What we see is that the earnings of the companies in the S&P 500 has been very strong. Okay, so if I were to look at what has been reported so far in the fourth quarter earnings season, effectively, a lot of companies have been able to exceed the market expectations. Okay, based on what Bloomberg has compiled, close to 80% of the companies actually exceeded the market expectations on the earnings. And if I were to look at the earnings growth, we are looking at the fastest pace of earnings growth since the middle of 2022. Okay, so in the fourth quarter of 2023, the S&P 500 firms actually saw earnings growing by more than 5% on average. And that is actually the fastest pace since the middle of 2022. Okay, so this is really what has driven the rally as the US economic growth has been very resilient. This has translated to stronger earnings growth for the corporates as well. Okay, what are we seeing closer to home? We saw that the STI actually had slight losses in the past week. Okay, if I were to look at the gains, most of it was driven by the Jardine-related names. So Jardine Matheson, Jardine Cycle and Carriage, DFI Retail Group, as well as Hong Kong Land, all being one of the top gainers in the past week. Outside of the Jardine-related names, we also have DBS, which reported their full year results last week, and actually had a gain of 1%. Okay, so this is a name that I'll go through in a bit more detail later. Okay, in terms of the worst performers, we see that some of the REITs are starting to give back some of the gains. Mapletree Pan Asia Commercial Trust down by 4.8%. We saw earlier that the US 10-year government bond yields are moving back up again. And likewise in Singapore, the 10-year Singapore government bond yield is also starting to move up. And that's explained some of the losses in the REITs that we see. Okay, outside of the REITs, we also have Seatrium down by 13%. If you recall what we saw in terms of the company issuing the profit guidance, that the losses for 2023 would be wider than the losses in 2022. So impacting sentiment towards Seatrium, which was one of the top losers in the past week. Okay, so I will talk about two stocks that saw very strong share price performance in the past week. The first is DBS. We saw that it was one of the top gainers within the STI. Okay, so bouncing back to about the $32.50 level after they reported their full year results. Okay, so ang pao for DBS shareholders, even though what we saw is that the fourth quarter net profit was down about 9% compared to the previous quarter. Okay, so fourth quarter net profit at about 2.4 billion. Okay, on an underlying basis, this is down 9% compared to the third quarter of 2023. If we include some of the one-off items such as what they have set aside for charity causes, then effectively what we see in terms of the net profit in the fourth quarter is down about 12% compared to the third quarter. Okay, what is driving this decline in the earnings compared to the third quarter? Effectively, the net interest margin has come down compared to the previous quarter. Okay, so if I were to look at the net interest margin, it has been on a consistent uptrend through the third quarter of this year and reaching a high of 2.19%. Okay, but in the fourth quarter, that has moderated down to about 2.13%. And the company's guidance is that this trend of the net interest margin being down from the peak will likely extend into 2024. Okay, so the slowdown in the Fed rate hike is starting to impact the net interest margin, which also led to the decline in the profit compared to the previous quarter. Okay, but what is the good news for shareholders? They've actually raised their dividend per share to 54 cents in the fourth quarter. Okay, so this is an increase compared to the third quarter when the dividend was 48 cents and higher than the fourth quarter 2022 dividend per share of 42 cents. Okay, so overall for the full year, the higher profitability and returns has translated to higher dividend per share, amounting to $1.92 in total for 2023. Okay, on top of that, another good news for shareholders, DBS has proposed a bonus issue of 1 bonus share for every existing 10 ordinary shares held. Okay, so what this means is that if you have got 1,000 shares in DBS, you will receive 100 bonus shares of DBS. Okay, the date that this bonus issue will be allocated has not been announced. But what is important to note is that you do not want to have odd lots in DBS shares. So for example, if you were to buy 100 shares in DBS today, you might potentially end up with odd lots in the bonus share issue. So that is something that investors of DBS need to be aware of, because it might then be difficult to then buy or sell the odd lots in DBS shares. Okay. The other point to take note of is that if I were to look at the dividend guidance that DBS has, if I look at the 54 cents for the fourth quarter, and if I were to analyze it, that will be $2.16 per share. And what DBS has said is that this will be applied over the enlarged share base. Okay. So this will potentially mean a further increase in dividends for 2024, because this dividend per share of $2.16 will be applied over the larger share base. Okay. So in total, if I'm looking at this $2.16 applied on the larger share base, which is 110% of what it is today, then that represents a 24% increase over the 2023 total dividend per share of $1.92. Okay, so that is DBS dividend. If I were to look at the annualized dividend per share of $2.16 and apply on the larger share base, that will represent a potential dividend yield of about 7.5%. And if I were to compare to what investors are now expecting for the forward dividend yield of UOB and OCBC to be, then DBS is expected to offer a higher dividend yield compared to UOB as well as OCBC. Okay, so definitely something that investors are looking forward to, and that has driven the bounce in DBS share price in the past week. Okay, next I'll talk about another stock that saw very strong gains in the past week, StarHub, which went up to $1.16 after they reported their full year results as well. Okay, so breaking out of the range, it's been pretty much between the $1 and $1.10 level for most of the past year, and it has effectively broken off the range to $1.16 after the results. Okay, so what actually led to the very strong rally in StarHub share price? They reported earnings of 72.9 million for the second half of 2023. And this is actually a very big jump from the earnings in the second half of 2022. If I look at the full year 2023 earnings for StarHub, 150 million, which is a 140% increase compared to the full year of 2022. Okay, what we see here is that the service revenue actually grew in the second half of 2023 compared to the second half of 2022, and the margins for StarHub improved as well. Okay, so if I were to look at the revenue, there was growth across all the segments, whether is it in mobile, broadband, entertainment, as well as enterprise. For the full year of 2023, there was revenue growth compared to the previous year. So from an operations perspective, we are starting to see that things are looking up for StarHub. And I think what investors also like is the dividend per share. Okay, they declared a higher final dividend per share of 4.2 cents, and that will bring the full year dividend to 6.7 cents. Okay, so this is better than expected, given that the company's guidance is for the total dividend for the full year to be at least 5 cents. Okay, so overall, I think what investors like is that the service revenue has exceeded expectations. The dividends are higher than what they previously guided for, and that will translate to a fairly attractive dividend yield for StarHub. Okay, so what to look out for in the year ahead? StarHub has given some guidance as well. They are guiding for service revenue to be able to grow by 1.3% compared to the previous year. And that will exclude the impact from the Decrypt divestment. Okay, if I were to look at the dividend per share, they are guiding for at least a 6 cents dividend per share. So that is once again helping to support the share price of StarHub, given their guidance towards the dividends this year. Okay, so quite a number of good news that we have seen for investors. S&P 500 exceeding the 5,000 level, DBS reporting a higher dividend as well as a bonus issue, StarHub reporting stronger earnings as well as a higher dividend payout. In terms of what to look out for in the week ahead, we have the US CPI data that is coming up, which investors will use as an indication on what the Fed next interest rate move is going to be. For investors of the T-bill, we have an upcoming 6-month T-bill auction that's coming out on Thursday. And last but not least, for us in Singapore, very closely looking out for the budget, which will be announced on Friday, to look at what are some of the moves that the government will have in the coming year to be able to support either us as consumers or different businesses. Okay, so with that, I'll hand over to Sunny, who will share with us what are some of the technical indicators to look out for.
Okay, thanks, Gerald, for the insightful sharing. Yes, it's likely going to be a busy week this week as well. On top of what Gerald has shared, the Singapore budget, that is where we look forward to our ang pao every year from the government. On the US side, we are besides the retail sales number on Thursday, as well as the PPI number on Friday. And of course, we also have 14th of February, Valentine's Day, to celebrate as well. So I think it's going to be a busy week, and I think the market is not going to slow down either. So let's look at the STI first. So this is the STI chart that we are looking at right now. Okay, so after the December rally, as we have gone through in the past few edition of the weekly market review, market has been trending downward and weak because what the indicators are telling us, we are going into a range bound or even a slightly weaker market. You can see that the MACD indicator on the STI has slightly went below the zero baseline already, meaning that there's a now negative momentum in the STI index. Although that negative momentum may not be very strong, but it's still below the zero baseline, and a negative number means that we have very weak momentum in the STI index right now. The RSI has also gone below the 50-point neutral mark, meaning momentum is weak as well. It's also below the 14 days RSI moving average. So likely we will see a little bit more of a downside momentum on the STI index. So both indicators, MACD and RSI, agreeing on each other views that we are likely going to see weak momentum on the STI. So if that is true, in the early part of February or late part of January, we sort of forecasted that STI is likely going to come down into this area and test the 3,150 points level. We sort of breached that. We have a bit of a bounce, so this becomes the pivot point level, I would say, 3,150. But I'm seeing that with the indicators showing weaker momentum coming, we may see the downside slide continue a little bit more towards this zone over here, which is where I see the last support of the before the December rally happened. That's around the 3,090, or I round it off to 3,100 point level. That will be my next support for the STI level before I consider an entry. So in the past week, we have seen on 2 occasions, at least on Tuesday and Thursday, there were dips towards this area, but we are not really there to the 3,100 points level yet. The lowest we have gone is 3,138, which was 3,117 on last Friday. So that is 17 points away from the 3,100 point level before I will start to sort of think about pulling the trigger to take some long position on the SCI. So at this moment, I'm going to expand this zone over here. We have still not reached the support zone that ideally we are looking at. And I would, when we reach that zone of 3,100, I will want to relook at the indicators again for them to show some signs that the STI index is oversold already, or show some signs of a turnaround for a bounce back up. So, but as of this point over here today, there is totally no indication of that from the indicators. Hence, I'm taking a wait and see approach for the STI index for now. Next, let's move to the US indices, which had no holiday. And as what Gerald mentioned earlier, the rally that we have been seeing since the beginning of the year is powered by the great earnings seasons that we have. Going forward into this week, we are expecting another 60 companies, 60 companies from the S&P 500 going to report their earnings, including Coca-Cola and Kraft Heinz. So those are the names that will give us insights into the strength of the economy in US, the consumer spending strength, the consumer sentiments there. So that may be another leg that will probably push the index higher. That's my opinion, because based on how the companies have reported this earnings season, like what Gerald said, 80% of them have exceeded the market consensus or analyst estimation. So I think the balance of the earnings season, right, will not be a surprise. It will likely be just slightly above the analyst estimate, and hence that could be the next leg where the index will continue to push higher. Beyond that, it is a wait and see approach. It will be very much more data dependent. Like what I said earlier, we have the CPI data this week, as well as the retail sales and PPI data. So these are the key figures. Most of the numbers that I see, or most of the market consensus on the data that I see, is likely to be in line with the previous month. So if we have any outperformance, that might drive the probability of the interest rate cuts further down towards the later part of the year again. And that could be the reason why, or that could be the catalyst for a pullback in the major indices. Okay, for the Dow Jones Index, we are at 38,797 points. We are up about 0.33% it's yesterday night, because this is a Tuesday. So Monday night, it was up 0.33%. So the rally seems to be extending and gaining a bit of momentum as well. You can look at the MACD indicator. The trajectory has been flat so far, but it's a positive number. So there is a positive momentum on the Dow Jones Index, but there is no gain in that positive momentum. So we are still looking at it trending around the current level that we are seeing, 38,797 points level. Now, people are saying that the RSI index is very close to the overbought region already, and it's now reading at 67. So we have actually breached that somewhere at the end of January, where it hit the 72 points level. But if you look at the previous overbought level that is happening in December, you can see that the RSI actually hit a high of 86. So definitely the current reading here, 67, still have some way to run before it hit the previous high that we see at the point of the 86 point level. So I would say definitely now, although the RSI is close to the overbought level, we are not at the peak of the overbought level yet, and hence a pullback or a reversal is unlikely to happen soon, at least in the next couple of weeks. So this is my take on the Dow Jones Index. We are likely going to see the Dow Jones Index staying elevated on this level over here, and probably be capped by the upper bound of that Bollinger Band, which is the black line at 39,097 points level. So we still got probably maybe 100-point upside to reach the peak of the Dow Jones Index in the near term. Next, let's move to the S&P 500, which is the broad-based index. So we have a little bit of a pullback yesterday on Monday night. We are down 0.1%. We are now at 5,021 points as of a Monday night close. So the indicators on the MACD indicator, you can see that there's a bit of divergence between the MACD line and the signal line. And that divergence means that there's an acceleration of uptrend momentum that we are seeing so far, or the acceleration of the positive momentum. So the S&P 500 is slightly going to push higher based on the MACD indicator. On the RSI, the latest reading at 72 is above the 14 days moving average of the RSI at 69. And the peak that we saw RSI actually reached the 82-point level as well. So same thing, we have another 10 points more before the S&P 500 will peak. So meaning this is not the peak yet for the S&P 500. The remaining of the earnings season might provide further catalyst to the S&P 500. Of course, just like the Dow Jones Index, this is an elevated level. I will not encourage traders or investors to get in at this level. We are probably going to wait for a pullback at least until the 20 days moving average over here. The green line is the exponential one. The black line is the simple moving average, which is around the 4,900 points level. 4,900 points level before considering an entry into the S&P 500. So the setup of the indicators, the setup of the charts are all in the elevated zone, and hence time is not right yet for an entry to the S&P 500, or at least we would say, although we see a rally since the December period, it's not a it's not an ideal time now to go into the S&P 500 until we have the correct setup where we see some kind of a pullback or correction where we hit the 20 days moving average. On the previous occasion, it happened in the beginning of January as well as the middle of January. So these are signs that we look out for the index to come back down to bounce on the 20 days moving average before we get back in to ride on the rally again. Lastly, let's move to the tech-heavy Nasdaq Composite Index. So Nasdaq Composite Index also suffered a bit of a pullback on Monday night, down 0.3%, but nonetheless, it's still a very positive week for the Nasdaq Composite Index last week. So we are now also testing the upper bound of that Bollinger Band already. Nasdaq Composite Index, although have not hit a new record high, but the previous high that we saw on the Nasdaq Composite Index was actually in the year of 2021, towards the end of 2021, somewhere in December, I believe. That is around the 16,212 points. I believe it's a matter of time before the Nasdaq Composite repeat what has happened in the S&P 500, where we have a new all-time high because the Magnificent Seven and the tech stock has been powering much of this rally, taking much of the load for the rise that we see so far. Okay, so the indicators, MACD is showing signs that the uptrend momentum is expanding again. So we may likely see the acceleration of the Nasdaq Composite Index to test the 16,000 point level. So it's just a matter of time. If it's not a yes or no, it's a matter of time before we hit the 16,000 level. The RSI has also breached the 70 point level, which was on last Friday, but on Monday it came back down slightly. We are now at 69 points, but nonetheless it's still above the 14 days moving average on the RSI, the yellow line that you see over here. The peak that we saw the RSI touch was at 79 points in December for the Nasdaq Composite Index. So definitely the 69 points, another 10 points up for the RSI is still not an issue because we have seen that happen before based on the historical behavior or pattern that we see. So expect the Nasdaq Composite to test the 16,000 level in the next couple of weeks, I believe, towards the end of the earnings seasons. And after that, due to a lack of catalyst or maybe the interest rate cut gets delayed again, we may see a pullback towards the 20 days moving average, okay, over here, which is around the 15,500 points level. That is the time where I would continue to load up on the Nasdaq Composite Index again. So all the index are all elevated right now because of the strong earnings seasons. So do be caution on trading on the indices. And of course, if you are choosing on specific stocks, do look out for the earnings results to give you a better perspective or reasons to put your money in on that particular stocks. And that's all I have for this week weekly market review. Any additional words, Gerald?
Well, my additional words is really to wish everyone a happy Chinese New Year once again. Do continue to enjoy your festivities with family and friends, enjoy eating your pakwa, and enjoy catching up with your loved ones during this season.
Yes, so I think I also wish our viewers again a very happy Chinese New Year and have a prosperous year ahead, and continue to educate yourself on how you want to invest in the markets, because that is where you would be getting your next ang pao maybe. Okay, and I think that's all the time that we have for this week Chinese New Year edition of the weekly market review. Thanks everyone for taking time to view this week video, and we hope to catch you again next week on Monday for our usual weekly market review session. Thank you.
Thank you.